All right, welcome everyone. Welcome to the Hurley Investments Market View Commentary for the 20th of March 2023. Today, I want you to be the advisor. And my first question, what is going to happen to our markets? I'm asking you guys. You are the advisor today. What is happening to our markets? So interesting. Maud said it depends on Powell. That dang T button. Okay. What else? Depends on Fed. That's Powell, right? Rate hike Wednesday. Most probable will go down. And I like that. And how much? We don't know. Maud, depends on if any more bank failures. Of course, we're going to have more bank failures, right? Depends on if there are any more bank failures. Love it. Swing back and forth depending on media and what they throw at us. Okay, so I love all those answers. The correct answer is, how far out in time are you asking? Right? How far out in time are you asking? I kind of giggle a little bit. I giggle a lot. Oh, Kevin, what's happening in our market tomorrow? And we focus our attention on the single day. But when you talk to an advisor, you're typically asking, hey, what was last year's return? Not the last 2, 3, 5, 10. It's what was last year's return? As if that's the qualifying question that some people feel they need to ask. Some people think that moving to another advisor is diversifying their funds. It's probably pretty important to understand what the other advisor is going to do with your money. And with that said, I am a big believer that we don't do nearly enough of studying. The majority of my people in my industry get your money and they don't do a darn thing afterwards. They just don't. It's like the game was getting the money and it's over. I love this report and I can't publish it. I'm not allowed to publish this one because this is an insider investors relations. I'm not able to publish this. But I can teach you what they're saying. you guys are my advisors. What is the expected S&P 500 earnings for 2023? There was a range, but what was the consensus for the earnings for 2003? Wow. 16 times earnings, 9% growth, increase, and bills, just a guess, $127. Holy crap. I'm a little confused right now. Right? I'm a little confused because I don't understand what you guys just told me. Because in all honesty, every single one of you said a piece of the question. 16 times, 9% increased, $127. Renee's like, you dummy, nobody knows. Of course nobody knows, but you make your projections on the S&P earnings. And I found it pretty easy because the projections were like really 166 all the way up to, I think Morgan Stanley was 228. And in general, the earnings were expected to be around $200. That was the expected. The growth rate, or the PE ratio, which is what you multiply it by, times the PE ratio of 18 times earnings, gives you this year, based off the earnings of the S&P 500, and they take, each company and the portion they do, but it equals a round number of roughly 3,800 on the S&P 500. And all you're doing is taking 18 times 200. If you were Morgan Stanley, 228 times 18 equals 4,000. So Morgan Stanley said 228, which would equal 4,104. Is where the S&P would finish. And today, well, why am I going to there? And today, we're sitting at a close of 3,951.57. We have a problem. We have a problem in that, gotta get that out of there, in that, did I blow that? I can't believe I just did that. S&P 500 estimates 2023. I can go down to fact check. There we go. The problem is the projected earnings showed a decline of 5.1%. 5.1% decline. And the problem is for the next quarter, it's probably going to be a decline of 3.3. And the yearly projections are showing that we're probably going to be down about 6.6 because we won't grow as much. So let me put this into a different way to look at it, right? $200 times, we're going to lose 6%, which means we're only going to have 0.94. We take $200 times 0.94, $200 times 0.94, only give us $188 of earnings. Multiply those by the generous 18 times earnings that we think we're going to get. That gives our S&P a 3,384 ending year total. Which means if we're looking at a chart, oh, come on. Which means if we're looking at a chart, come on. Boy, my internet is slow. We have had snow up here in Alpine. Let's do it the quicker way, maybe. Which means, wow, we're not even there. Let's go back another year. Which means we're expected to be lower than the 3491.51 because we're expected to be at 3384. So here's my question. What do you tell your clients that you just lost 33 to 40% last year in a 60-40 mix when mutual funds are the alternative to the bond losses? What would you guys tell me? I'd play devil's advocate today. And I called into a couple places. Oh, so David kind of said it perfectly clear. That sucks. I love move to Hurley Investments, but what do you think those guys are saying to people? What are they going to tell people when we just work the numbers and that's what we're coming up with? Give it to me. Go ahead and give it to me. You know what, William? That is very interesting. William just typed in, Kevin, I'm going to lie. Wow. What would your lie be? I'm curious. Bill Branner nailed it. It will come back, so just sit tight. Pretty common, right? There's a funny one. Aren't you glad you invested with me, right? Hey, we just lost you 30 to 40% last year. The 60-40 mix isn't working either, but aren't you glad you invested with me? Interesting. May want to sell more funds that have done better in down years. So there you go. Someone's going to say, hey, I'm going to churn you. I'm going to put you into other funds because it's been maybe a 1 or 2 year period that I'm going to get a commission or a bonus on. And off we go. There's another good one. Move to cash. Put me in cash. Most people won't do that because I can't charge you if you're sitting in a bunch of cash. I've got to have you like 96% vested if I'm a typical standard broker. William, you haven't told me what you're going to lie about. So 2 phone calls today. Number 1, I would expect the market to come back the back half of the year. When I asked him when, June, and now is a great time to buy lower than December. That was number 1, which again kind of seems like a line, but again has done 0 research and picked the highs of last year. But again, take a look at the chart. The highs were really February. So it's kind of funny, as I talked to him, he missed when the highs were. He was trying to use December when we had higher highs in February. And in his mind, June, we're going to stop raising rates. Hasn't been following along with anything, right? William, I'm going to go ahead. I'm going to put that in there for you. Renee, I'd say we're going to move to cash until I study and figure out some alternative methods that can work in a crazy market. William, I'm going to type that word for word, and I know you're overseas, but let me just say what it is. I'm going to lie. You're going to make money most years, so don't worry. I mean, that's really, really pretty good. Phone call number 2. I kind of thought was even better. it depends on your time horizon, but a dated, and I'm assuming it's like expired dated, but a dated 60/40 portfolio allocation is always the best way to run a portfolio. Didn't ask me how old I was, didn't ask me what my time horizon. He basically is making an excuse for why the best time horizon is the 80/40. And I just sat there and I thought, wow. Wow. Here's what I'm going to tell you. Here's the simple. We are hedged for Wednesday rate hike. And Powell is penciled into a corner. He can't not raise rates. No matter what's happening with the banks. And the funny thing is, let's face it, a quarter point in March is not going to affect the banks for their poor decisions a year and a half to a year ago. It will mean that they're less likely to borrow against the bonds. If anyone has not watched last week's commentary, please go to myhurleyinvestment.com and watch it. I spend a lot of time explaining exactly what our problem is. But let's just put this into an understanding. And we're going to use a couple real numbers, right? T-bill, short-term rates have been over 5%. The inversion between the 10-year notes and the 6-month bills have had a spread, meaning that the have had a spread of 110 basis points, meaning that you can get 1.1% better return on the short-term bills than the longer-term notes. Because of this inversion, banks will find it hard to, how do I say this? I'm just going to say it this way, to borrow against and make money this year until they clear it off the books. Bank of America, JP Morgan, Goldman Sachs run and offer different money-making products that are sheltering them from the problems you're seeing on the central banks. And credit unions are not big enough to put themselves in these kind of positions. We have a problem. PPI last month was up again another 0.7. CPI is getting better because in February it was only up, what, 0.3? Let's take a look at that really quick. Let's calculate how much inflation is up this year. Gotta love it. Let's just find out what our inflation rate is this year. Not this week, probably not next week, although PCE prices are in. This was a big one last time, right? Inflation year over year. January, it was 4.7, bigger than the 4.6 in December, but better than November and October. So it was trending down until January, right? So I think it's before options expire. PPI and CPI, let's find them. Oh, there we go. It's going to be in this week right here. CPI and core CPI. Little bump up. Ouch. Looks awful. All items. January was 0.5. February was 0.4. Year to date, we are up 0.9% inflation, which means we could have a 50-point base rate hike in the March meeting. Again, we are running in trouble. They want 2% per year as a target inflation rate. Man alive, we hit 0.9. We almost hit half of that in the first 2 months. Anyone think that, is there any way possible that Powell does not raise rates in March? Because that's all I heard. In fact, I heard it so much on CNBC today that I had to turn off the TV. Biggest load of crap I've ever heard, right? It looks bad. It looks real bad. I mean, we are nowhere close with all of these interest rates that are going up. We are nowhere close to being in line where the Fed can say, hey, we're not going to raise rates for a while. This was a big one for me. Someone tell me, who is Marty Walsh? Can anyone tell me who Marty Walsh is? I'm going to go big conspiracy theory on you right now. If you don't know, type a couple question marks in so I don't wait too long. Who is Marty Walsh? Anyone? Marty Walsh was the former labor secretary that resigned the day after the ridiculous 517,000 jobs number came out in January. Scary, ridiculously scary. I'm just going to throw a couple more things out there. Fed, ECB, the Bank of Japan, holding $22 trillion of U.S. debt in treasuries. I'm going to throw another funky cold number at you. Central banks hold a lot, and I'm just going to say that loosely. I'm not getting exact numbers because they can hide it, right? Hold a lot of weak mortgage debt, meaning well, that's not true, meaning 1 to 2% interest rate. Where they make their money, right? A lot of weak mortgage debt, 1 to 2 point interest rate. I've got mine at a 20-year 2.25, I believe. And their portfolios going mark to market, meaning what they bought it for and what it's worth right now, show huge losses, meaning minus 70% or more. It is ridiculous. So here's the last question for you guys to think about. What did you expect with all the QE? Quantitative easing. So that's a question for you guys. What did you expect with all the quantitative easing? Billions upon billions upon trillions of dollars. I honestly feel back in, I want to say what, 2010, the 3.6 trillion was like, what, 70% of our 5.9 trillion GDP that year? Real GDP. Someone answer me. What did you expect with the quantitative easing? I've got 4 answers for this too, but what do you guys think? You're living through it right now. Bill, great answer. Love it. Perhaps the printing presses at the Treasury are running hot. Love it. Anyone else want to give a go at it? So Derek, David, excuse me, when you say the party should be over, what do you mean? What in your mind is the party? Entitlements. Okay, yes, but the entitlements should be over. They're not going to be, but relate that to quantitative easing. I mean, I guess I'm asking. So yeah, okay, I get it. I'm running it through my head here. We have someone that's saying entitlements should be done with. Now, if you're saying entitlement should be done with, that will probably count Medicaid, Medicare. It would probably count unemployment. It would probably count food stamps. What do you think? Because we spend so much, it's kind of funny. Because our GDP is based on spending, I think my parents are the last generation that are like, what, 74 and 80, are the last generation that can probably make it on their own without those entitlements. It would be tough, but it's interesting. And wow, I've got 3 good comments here. Why is welfare never in trouble? It's always in trouble. It's always in trouble. It always goes over the budget. They always print more money for it. But it's that hook on the fact that, you know, Clinton borrowed from Social Security when we were in a boom. And, you know, it's just the short answer is it's always in trouble. It's in trouble of running out all the way across the board. Eventually, there has to be a correction, not just with the market, but with the things that are corrupt. We had one for 4 years. Again, Donald Trump would not be a friend of mine, but I loved how he ran the country. For every new program, you had to shut down 2 that were going to equal 2 times what you wanted to spend. Opened up the spigots on our energy in the United States. You know, he might not be he might not be a moral person, but we get conflicting reports, right? Gives his plane for cancer patients in the Army to get back and forth, yet supposedly slept around with a bunch of women. Kind of weird. I kind of feel he was honest. He had so much money that, you know, it was like, hey, I take advantage of the tax system because I'm supposed to. That's how I generate hundreds of thousands of jobs. And at times, those jobs have gone bankrupt. Those companies have failed. I find it really interesting. People held that some of his companies went into bankruptcy. If you truly ran a company for the employees, they tend to go into bankruptcy. It's kind of what it is. With quantitative easing, my first red flag would be the reserve currency status. The moment that goes to a basket, we are in trouble. We are in big trouble. Second big red flag, right? Second comes down to, can't spell, interest rates. over 8%. Third, a switch back and forth with interest rate hikes. If we see him pause, cut, then raise, stay this, pause, then raise again, cut, then raise then cut. If we see that back to back, that's going to tell you right at that point, the Federal Reserve has made a big mistake and that they truly don't know what they're doing. Just to let you know, if you see that go back and forth, you're going to see mortgage rates in the teens again, like the 80s, which will grind our economy to a halt. And the fourth red flag, probably the most important, if the Democrats win the elections, and I mean if they win the presidency, if they win the House, they win the Senate, if the Democrats win and have that majority, the entitlements and the quantitative easing pushes itself into an unpayable accounting nightmare that we can never come back from. I don't know if we could come back from the loans and the 31 trillion we are in debt already. Well, Kevin, it's really 120 trillion. And that's not true because you can cancel those payments. You can cancel the future payments if you have to. We're 31 trillion in debt. Mathematically, yes, we still can find our way out of this, even if we would just start to make payments on our debt. But these are my worries. We see reserve currency status. Everything we buy is between 16 and 35% more expensive. Interest rates over 8% for home purchases kicks out, in my mind, about 45% of people that wanted to buy homes. If we see the back and forth, mortgage rates are going to go to the teens. That probably kicks out 75% of the people that want to buy homes. If the Democrats win the election, Democrat president, Democrat House, Democrat Senate, it truly is over. It's over. Mathematically, we cannot come back from the spending. Which means, and it's kind of funny, right? William, there's no amount of gold or silver that you have that will matter. But you want to know what will matter? Food storage. Homes paid off. Hedge portfolios for the days that the market can come back. And all they have to come back is 5%. It's not a huge one, right? 5% and you can be profitable on your collar trading. But those will be some of the things that matter. Wow, I feel really political. All right. No big earning dates. Briefing picture. Go to the bottom, what it all means. Basically, all they're trying to say here is what I told you, that it's going to be difficult to find a bottom as we keep heading down, as we keep getting these ridiculous expectations. They made friends fell in the 4 total earnings estimate. Wow. So yeah, I mean, I didn't think about the recalibrations and the pulling it down. What if all those numbers I worked with you up above drops down to 16? That kind of puts 3,000 in play for the S&P 500. Shocking. Still bearish on the Dow. In fact, something that I found interesting, I don't think we've realized just how bad this month has been. The last 5 weeks, last month we were down 3.13%. The last 5 days, we've been up 2.48, which means if you take out those last 5 days, we have been down 5.61% on the S&P in the last 4 weeks. Ugly. Really, it's the last 5 weeks. Last 5 weeks prior to last week, actually, I guess the 4 weeks before last week, we were down 5.61%. Caught in a range. Caught in a range, can't get above the 200-day simple moving average. 1, 2, 3, 4, 5, 6 days we've tried to get above it. No real catalyst on the future. Is the risk to the upside that we're going to miss getting back up to 34.7? Or is the risk to the downside that we're going to go back down here and test 28.7? Are you more worried about not making money to the upside? Or are you more worried about losing money to the downside? I know I'm more worried about losing money to the downside, right? S&P 500. 1, 2, 3, 4, 5th day it stayed above. 6th day did not. Today we're back above the 200. Almost excited. But let's face it, tomorrow will probably be pretty flat. Wednesday, we're going to go one way or the other. Are you more worried about missing 245 points to the upside? Are you more worried about losing 450 points to the downside? Right? That's the give and take. NASDAQ. Kicking the index's butt. We just got a crossover. The 50-day over the 200. Historically, next 6 months, we're looking like an 8.3 and 8.4. I don't remember exactly, but we're looking at an 8% plus return in the next 6 months on the NASDAQ. Good reason to maybe be adding in some opportunity there. All righty. Start thinking of the questions you're going to have for me. Not a whole lot happening with earnings. These are probably the same ones you saw last week that I just missed it by a week. I think we got Nike on Tuesday. I'm pretty sure. I hate to think I'm doing this wrong. If I look at earnings, though that doesn't seem right, this week, seems like Nike just had their earnings. To the close on Tuesday, March 21st. Wonder if Briefing has their stuff right. Economic reports, pretty quiet week, except for the FOMC rate decision. Durable goods, durable transportation, probably going to be down. New home sales is down significantly because of the raising rates, even though we had a couple weeks that the rates came back a little bit. Doesn't look good at all. This is the week to go down. This is why. Found an interesting article. Beware these S&P 500 stocks expected to struggle. T. Rowe Price, Consolidated Edition, Expedition International of Washington, Clorox is what caught my eye. Campbell's Soup is what caught my eye. A couple of these that I thought were stalwarts, right? C.H. Robinson, Pinnacle West to Capital. I could see why they'd be in trouble. Fed poised to approve a quarter-point rate hike this week, despite market turmoil. He's penciled into a quarter. He's got to do something. And he's in no position to say, hey, we're going to hold pat. Very interesting article. Please read through this. Elite dividend stocks have raised their payments over 60 years. I like this one. Coca-Cola, Colgate-Palmolive, Johnson & Johnson, Procter & Gamble, Emerson Electric, and General Auto Parts. I just threw this one in here because a couple of you talked to me about jobs here recently. The millionaires, the guys that were older and said, you know what, if I don't make a change, I'm never going to get there. 51% became entrepreneurs. 20% had the traditional 9-to-5 jobs. The other ones were working more. 18% were senior executives. But reason why they quit and went for the big money, right? Tired of being underutilized, had toxic bosses, dread their office culture. I hated the office. They weren't paid enough for getting raises. They had a draining commute. The industry was unsteady. Guys, what questions do you have that I can answer for you if I missed it somewhere along the way tonight? If you have any questions for me, please type them in right now. And David, you asked, what rabbit can they pull out of a hat? The only rabbit right now for the government is to keep printing money, to keep kicking the can down the road. There are no other rabbits to pull out. The reality of taxing businesses or taxing the wealthy so they pay their fair share, I mean, it's kind of ridiculous because if you're a business, you pay taxes as you buy your goods, whether it's training people, whether it's materials, you buy your taxes on that. You pay your taxes on that. You pay taxes on your building. You pay taxes on your business taxes. You provide jobs for thousands of people, and their money that you pay then gets taxed. For those people that have, homeowners or property taxes, you've got taxes on the stock market, taxes on On the state, the Fed level, you have taxes on estates that are left behind. It's just to think you're going to tax your way out of the huge, ginormous, screwed up debt that you're in. It just doesn't exist. In fact, if you were to take like the top 100 billionaires, which we don't even have those in the United States. If you were to take all the billionaires in the United States and confiscate all of their wealth, you wouldn't even pay down the debt, national debt. I think it was by like 10 or 11%. So and that's confiscating all of their wealth. It just doesn't make sense to think you're going to tax your way out of this huge hole that you dug yourself. And it pisses me off. I mean, I'll be honest with you. I paid an extra 2.8% alternative minimum tax last year, and taxes for me were high, which means I had no way to purchase another employee, a secretary, better leads, more stuff. And that was after a kid that went through traumatic brain injury. So it was awful. Not a good year. All right, I see no questions coming in. Guys, you have a wonderful evening. Maud, if you don't mind, text me a time and a day that would be good for you this year. Renee, my wife, is going to get a hold of you so we can talk. And Stuart, I'm going to call you as soon as we're done. Guys, I appreciate you being here tonight. I hope this was helpful. I hope that this made sense for you to work on calculating what we're doing, what we're up against, what the year is expected to be like. I just wanted to give you the hard part that probably as Bill and I think David said today. I think as you work the numbers, the lies become more and more apparent. I mean, I've never heard of, a labor secretary should be asking for a raise, and instead they quit. Boy, that's going to be some serious conspiracy theory there. Renee, these articles will most likely be posted sometime by tomorrow morning. But everything that we've had in the past is there. Last week was very important to understand the banking and what was happening with the banking. All right, guys, have a wonderful evening. I appreciate you being with me so long tonight. Look forward to seeing you next Monday night. Have a good evening, and I'll talk to you then. Bye-bye.